Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In prior LONGWave videos, we have discussed what we identified as major megaphone pattern formations at various degrees of price and time. We are reaching the termination of the larger degree megaphone pattern, and therefore I thought it important to revisit what that may mean going forward. I also want to do this in the context of some other observations as outlined here. You've seen this schematic before on how we analyze markets in marrying up market drivers such as sentiment, risk, and fundamentals with longer-term macroeconomics. In this session, we're going to bridge the two from a technical perspective. We see the potential for a shock to soon hit the markets. We are showing here what we see as the very large degree megaphone pattern in the S&P 500 that started with the peak of the dot-com bubble in March of 2000. In blue, labeled B, was the bottom of the 2008 financial crisis. We appear to be nearing the culmination of that pattern. This megaphone pattern has been showing itself as a fractal pattern at ever smaller degrees. The red megaphone pattern shown here and labeled C, D, and E is the next smaller degree. That degree for the S&P 500 is exploded here. It started at the beginning of 2018. It has been our experience that repeating smaller degrees of a pattern or fractals is a very reliable technical indicator of what might lie ahead. If that is the case, we should be able to identify further patterns if we drill down. I'm showing here the price action we have seen in the S&P 500 since last September, up until about a week ago. I have shown some annotations in green we were tracking at the time concerning the current level commodity trading advisor Gamma Traders were using as a strike price. It has since moved up to north of 3,900 on the S&P 500 and around 1.15 to 1.18% as a rate on the 10-year U.S. Treasury note. We'll come back to that a little later. I've laid in two trend lines in white that show we have a potential ending diagonal emerging. An ending diagonal is also another fairly reliable technical indicator. Connecting more lows and highs within the pattern, we see a converging area emerging. The labeling as shown here illustrates that we have the labeling of the megaphone pattern, which also exhibits an A, B, C, D, E kind of count. It appears that this ending diagonal will end in the time frame that correlates with the February options expiration. This doesn't come as any surprise to those that watch charts on a regular basis. What jumps out of this chart is we once again have another megaphone fractal identified in the white box. It may not be obvious because of the trend, but if we show the same price action within an orthogonal representation, it becomes clear. This is the same period with the same price action updated as of Monday close, February the 8th. This is exactly what we would expect from our years of watching such fractal patterns. The fractals tell us to beware of a potential market corrective consolidation developing that will be a large price time degree. Let's shift gears and see if we can put some framework on what that consolidation correction may be. The following charts appear busy, so we'll only focus on some key points that they individually suggest. The chart of the S&P 500 going back to the bottom of the financial crisis shows a maze of Fibonacci support and resistance levels. The dotted red line shows a potential parabolic blow-off top for the markets that we felt was underway over the next 5 years before the March 2020 COVID-19 driven market sell-off. The solid red line shows that parabolic sell-off adjusted for the COVID-19 market shock. The analytics behind this chart is suggesting an S&P 500 low of 3270 sometime in the summer of next year. However, corrective consolidation patterns ranges can form many structural patterns, none of which we, at least, can determine in advance. Therefore, we start with maximum conditions for the range, and by a process of elimination going forward, we slowly narrow down those possible patterns as the pattern emerges. We therefore show here a double bottom in the range and a double top. The double top will convince most people we're heading seriously lower than this chart indicates, while the double bottom or W pattern is typically of an important bottom. Also, we often have corrective legs that mirror the last leg up, but in reverse. Therefore, we arrive at a starting expectation of an initial bottom at the price of $32.70 in the summer of this year, and a retest of the $32.70 a year later. This also is an interesting correlation, as it is quite normal to see important market markers tested a year later. So at this point, we simply consider our market marker to be $32.70 sometime this summer. This is another long-term analysis of this S&P 500 using 12 and 24 monthly moving averages. We see that the current market activity may in fact be a throwover that often occurs prior to market corrective consolidations and reversions to the mean. It is interesting that our 32.70 market marker, shown in blue here with a red circle, lies at the channel's midpoint and in line with where the 24 monthly moving average is likely to be at that point. This is the same S&P 500 monthly chart but uses a log scale, so we are viewing a better representation of percentage moves. A band of long-term moving averages we use shows relatively hard support around a mean reversion that centers around our 32.70 price and time marker. Nothing is guaranteed in markets, but what we have found is that probabilities of success go up with the higher number of correlations you have working for you. One of the reasons is that today the market is almost solely driven by algos. They may all use different algorithms, but their algorithms all use many common market benchmarks and correlations. So they eventually start to reinforce each other, moving towards common market time and price points. I'm switching here to weekly charts and using 20, 40, 80 week moving averages. The indicators at the bottom show an overextended market, while the colored bands surrounding the S&P 500 price action as being very orderly and well managed. It is also signaling that a support test of the moving averages is overdue. We've again placed our 32.70 market marker. It appears to align with where we might expect the 80 weekly moving average to be during a possible move down by this summer. This is the same weekly chart drilled down a little and using different moving averages. We're using here the 50, 100, and 200 weekly moving average. The message here is that the longer term weekly moving averages would exhibit a much more normal set of profiles if we had price corrections towards our market marker. It would center these moving averages that would be tighter by then. Regression to moving averages is another high probability technical analysis understanding. Finally, if we look at a daily price action chart of the S&P 500, we see our 32.70 market marker exhibiting the potential for a very standard ABC correction towards 32.70. It will be interesting to see how our roadmap actually unfolds, but we have something to watch and gauge it if things unfold as we currently see them unfolding, or our indications are at least suggesting. Again, switching gears, we need to consider what would trigger a reversal in trend in the near term. What would be the trigger or catalyst? There are many. We can never be certain, but most times it's quite evident after the fact. What is very evident right now is the level of margin debt to the size of the economy. Normalizing margin debt by the size of the economy, we see we are well above anything we have ever experienced. Everyone is on the same side of the boat. Who is not in the markets right now and where is the money on the sidelines? But it is even worse than that. If we historically look at 9-month increases in the total margin debt, we not only see this record rate, but each time we've experienced this level of margin spike in rate, we've experienced a corrective consolidation. Interest rates are also rising and are breaking important overhead resistance. The 10-year U.S. Treasury note is now trading between 1.15 and 1.20. This places margin funding costs in peril. Inflation, as we've been pointing out in our recent newsletters, is showing itself across the board and around the world. The Fed is committed to buying $120 billion worth of assets per month for the foreseeable future. This means the Fed will be printing upwards of $1.4 trillion per year going forward, if not larger. That's roughly the size of Russia's GDP, the 11th largest country in the world. The Fed's not the only one pushing for staggering amounts of money printing either. The Biden administration will soon sign off on a $1.9 trillion stimulus program. It has also proposed a $2 trillion infrastructure program, as well as a $1.7 trillion climate change. That's an additional $4.7 trillion of money printing on top of what the Fed is already doing, $1.4 trillion per year. All of this is going to unleash an inflationary storm, the likes of which we have not seen in decades, if ever, and the market now truly knows it. Take a look at what the ratio between treasuries that trade based on inflation versus normal treasuries is telling us. You're looking at a 10-year deflationary downtrend ending as inflation begins to rip through the financial system. In the simplest terms, this chart represents the bond market screaming inflation is about to hit. As I pointed out in my last newsletter, the increase in inflation has some suggesting that further stimulus may be deferred. Specifically, EU is starting to suggest that right now, again, as I pointed out in the newsletter. The problem is the market is riding the wave of global liquidity. Anything that even suggests a slower rate would be a market shock. As you can see, we're already experiencing a deviation between the global liquidity proxy and the S&P 500 in the top right corner. The boxes show what happened the last time this occurred. It isn't like there is any money on the sideline to fill any disruption in liquidity pumping. Mutual fund cash levels are at historic lows. Frankly, this has the potential of seeing flash crashes. Who is going to be there to buy? We have yet to fully experience the downside of the shift to passive investing in broad market ETFs when nervous investors all start to hit the sell button of their PCs. Now that would be a shock even the central banks couldn't stop. And it may be something that just happens in a matter of a few days. I will close with this chart, comparing the post-financial crisis lift as we pumped liquidity with what we have been seeing lately. Markets simply don't go straight up without stopping at least occasionally to catch their breath. And this may be just the point in time. At least the charts are all suggesting this. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. That's a fact. I'd like to take a moment as a reminder. Do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.